इंडियन आईटी सेक्टर काफी टफ टाइम में है। एक महीने के बेसिस में Infosys has dropped by about 9%, TCS has grown by about 3%, HCL by about 2% and Wipro grew by about 8%. बट अगर आप यही सारे स्टॉक्स एक हफ्ते पहले देखते तो मोस्ट ऑफ दी स्टॉक्स हैड फॉलन बाय अबाउट 5 to 10%. तो क्या हो रहा है आईटी सेक्टर में? इस वीडियो में आई विल गो थ्रू व्हाट इज हैपनिंग इन द सेक्टर, विल ट्राई एंड एनालाइज कि ये क्यों हो रहा है एंड व्हाट यू कैन एक्सपेक्ट फ्रॉम द सेक्टर गोइंग फॉरवर्ड. On 15th April, Infy reported positive year-on-year growth numbers of about 8% and revenue increase of about 15.4%. However, यहाँ पे सबसे बड़ा पॉइंट ये है कि they completely missed revenue expectations by about 1,000 crores. Yes, 1,000 crores. Quarter 4 compared to quarter 3 fell by about 2.3%. ये काफी unexpected था, as the company itself has projected strong revenue and profit numbers for quarter 4 of FY23. Infy also missed out on improving its operating margin targets by about 0.5%. The only silver lining here is that the deal wins, the revenue pipeline for the company has stayed strong at about $2.1 billion. Attrition has come off at about 20.9%, but all other numbers have been very poor. Comments from management itself indicate that the clients want cost efficiency. They're looking for a path to margin improvement on their own numbers, and ultimately the path to margin improvement for Infosys is expected to come in the medium term, not in the short term. Few days before the Infy numbers, TCS also released its earnings for quarter 4. It reported a 16.9% year-on-year rise in quarter 4 numbers, and profit numbers rose by about 14.76%. Their operating profit margins were flat, was an expectation of improvement. Given the challenging work environment, TCS reported revenue growth at a multi-quarter low. The only plus point here, similar to Infosys, is that they had strong order book, which is at an all-time high of about $10 billion. And yesterday, Wipro released its own results, showing quarter-on-quarter comparison के basis पे उनका net profit गिरा by about 0.4% from 3,087 crores to 3,074 crores. Again, similar to all the other companies that we've looked at right now, it showed strongest ever bookings in terms of the recorded pipeline that they've built, and the quarter 4 bookings have gone up by about 29%. Now Wipro's share price, as you can see, has risen. This can be attributed to its share buyback and ultimately dilutes its own cash position, which means that the company will buy back shares from its earnings. ज़्यादातर मिड कैप एंड स्मॉल कैप आईटी कंपनीज एक या दो रेवेन्यू स्ट्रीम्स पे फोकस करती हैं ओवर अ पीरियड ऑफ टाइम. They lack the consistency of client deals, services that they can deliver, and business segments that they serve. We see more positives coming from mid-cap and small-cap IT companies. Tata Elxsi, जो primarily transportation, healthcare, and communications में focus करती है, that stock has done well in the last 1 month, showing a 11.3% increase in the share price. It didn't seem to be impacted by the fall in prices for the large cap IT firms during that period. In quarter 3, they also showed strong revenue growth, improved EBITDA margins, and showed strong profitability. We expect to continue seeing this over the next quarter as well. KPIT, which focuses on the automotive sector, also saw revenues increase by about 56% on a year-on-year basis. EBITDA increased by about 40% on a year-on-year basis. It saw earnings rise by about 11% in quarter 3. It has outperformed its sector by about 80%, having risen 67% in the last 1 year. Mastek, a small cap stock, reported an increase in revenue of about 22% on a year-on-year basis, and quarter 4 net income was up by about 18% on a year-on-year basis. EBITDA grew by about 4%, net profit was up by about 8.2% on a quarter-on-quarter basis, but down by about 17.2% on a year-on-year. Mindtree saw an overall growth of about 20% for FY23. Quarter 4 saw slower growth on the back of cautious decision making by clients and hiring freeze in the banking sector. While operating margins have improved, they are expecting to hit 17 to 18% operating margins this year. And what was the management's guidance for revenue growth for the current year? यहाँ पे बात इंटरेस्टिंग हो जाती है. इन सभी ने स्ट्रॉन्ग नहीं, रिकॉर्ड ब्रेकिंग ऑर्डर बुक्स की है. Revenue pipeline strong है, specifically for large caps, but management guidance for instance Infosys was the lowest in 6 years. TCS on near-term demand was the weakest in recent history, and Wipro is actually expecting quarter 1 of FY24 to grow about -3% to -1%. What this means is that they expect their revenue to actually decline, and this is not a good sign. Higher bookings are not translating into revenue growth, and this is the puzzle. Let's try and understand why this is happening. Most of the large IT companies like Infosys, TCS, Wipro have clients across geographies, especially in the US. हम जब भी US की बात कर रहे हैं तो इन्फ्लेशन की बात करनी पड़ेगी. Inflation US में has historically been 2 to 3%, but this has increased now to about 5 to 6%. Consumers felt the pinch and they have changed their behaviors, their spending behaviors, their preferences. Two-thirds of US consumers are actually concerned about inflation, and two-thirds are actually actively managing their budget by reducing the savings to cover their expenses. They're cutting back on discretionary spending, not making purchases that they used to make earlier. As consumer preferences are changing across the board, companies are also taking notice. Large retailers like Macy's, Walmart, and many more have cut back on their costs as consumers reduce spending. Those companies hire the likes of Infosys, TCS, Wipro, Accenture, and many more for their IT work. And cutbacks on IT spend for these companies has already started. And I'll tell you the impact of all of this a little later on. IT companies also work across different sectors, with banking being a key sector for many of the Indian firms. Global banking exposure, for instance, for TCS is around 38%, Mindtree is at about 37%, and Wipro is at about 35%. The banking crisis that has happened in the US and the UK with SVB and other banks, ye sab in very simple terms has happened because of a mismatch in their maturities. And this was all the result of weak risk management. Banking sector as a whole will see cost cutting and reduction in tech spends coming up, and a lot of this is already starting taking place. अगर आप regional banks की बात करें तो IT companies draw about 2 to 3% of their revenue from them. या फिर अगर large banks like Goldman और JP Morgan की बात करें जहाँ पे भी cost cutting and margins and profit improvement की बात चल रही है, all of this is meaning that the overall spend for IT budgets is going to reduce drastically over the next quarters if it has not already begun and doing so. With inflation being tough to control, strong likelihood of further rate hikes coming with an ongoing and a tough recession probably coming in, it looks like more companies that used to outsource their work, IT work to sort of Indian companies will continue to look for ways to cut costs, improve margins, cash flow and profitability. Due to COVID, many businesses needed to transform existing infrastructure and ramp up quickly to meet consumer demand. So IT companies found a pot of gold. Contracts were flying in, revenue pipelines were growing at an astronomical pace, and these IT companies needed to hire quick and fast, otherwise good talent would have otherwise gone to a competitor, or to tech companies who were looking to aggressively expand to meet COVID's impact. We all know what happened over time. Demand slowed down, central banks rose interest rates to control inflation, and the hiring frenzy turned to a firing frenzy. Let's go back to IT companies. Infosys, HCL and TCS saw almost a 65% drop in hirings. Hirings about 69,000 in FY23 versus 2 lakh last year. In the last quarter, IT companies saw a 98.7% drop in hiring. Attrition rates have also fallen. This slowdown in hiring is expected to continue till about September 23. Infosys saw utilization of its workforce drop to about 80%. That means 20% or around 69,000 people at Infi were not actively working or contributing to a project in Q4 or FY23, but they were still being paid a salary. All of these people are typically placed on a bench. What does that mean? Bench are those employees who are on the company's payroll, they are being paid, but they are not currently on an active project. Of course, there are employees who are there typically for upskilling. They may even lack relevant skills for the new projects. New hires typically also go to the bench and are ultimately deployed as and when resources are needed. But the fundamental issue here that we're addressing is that there was an overhiring during the pandemic, followed by poor demand due to ongoing global macroeconomic challenges, which has ultimately resulted in underutilization of the workforce and an increase in the bench size. This is the case for many large IT firms, including TCS, Infosys, Wipro, HCL, and many others. What does this mean? It means that the company will have to lower operating profit and net profit, as costs will increase since these employees have to be paid even if they're on the bench and are not ultimately productive from a revenue perspective. High bench size can also lead to various other issues such as productivity issues, low employee morale, job dissatisfaction, attrition, loss of competitive edge, and many more problems. If the bench size persists, there could be mass layoffs similar to what we have observed in the tech industry. Ruko, but ye sab to ho gaya na? All of this has been priced into these stocks already. Well, that's partially correct. What happens is that these companies release their guidance. The management talks about what they expect the next quarter or the next year to look like. In terms of a lot of these IT companies, the company guidance that they issued in quarter 3 exceeded what they delivered in terms of the actual earnings for quarter 4. Earnings expectation by analysts are typically based on the company's guidance. For instance, in terms of Infosys, while they only delivered a revenue base of about 15.4% increase, the actual expectation by the management in quarter 3 was about 16.5%. And this is the case across the board for many other companies also. When we combine all the 3 points together, we can piece together how higher bookings can translate into lower revenue growth. Now, this could mean one of two things is happening. One, delay in deal ramp-ups is ultimately impacting the revenue conversion over the next few quarters. Or two, delay in deal closures is impacting revenue conversion over the next few quarters. What does this mean? Well, IT companies were expecting revenue to come in at a certain time frame, but due to all the challenges that we're seeing in the global markets, companies are backing out or are pushing out these contracts for a later period in time. There could be various other reasons as well. For instance, companies could fall into bankruptcy. They may want to change their vendors. Typically, sometimes non-essential work can be moved in-house. But ultimately, what is happening is that the pipeline that they've built isn't being consummated and isn't materializing as expected. There is tremendous amount of deal activity going on in the sector right now. All deals are currently more efficiency and cost efficiency oriented rather than focusing on transformation. This is something that has changed from the last year, as clients are becoming more and more cautious and are taking decisions that are focusing on cost cutting, cash preservation, and ultimately how it will impact their bottom line. Industry leaders also, however, feel that this could be good news, because these type of cost takeout deals tend to be one longer term and ultimately give a more steady pipeline of revenue in the longer term horizon. With recession looming, strong dependence on US and Europe, liquidity concerns, contracts getting cancelled or getting pushed out, all of this means that these IT companies that are focused and have diversified their business to different sectors and to different geographies that are ultimately impacted by all of these challenges, they are facing a very cautious future in the coming months. From a long-term perspective, blue chip stocks like Infosys, TCS, and many others are ultimately blue chip for a reason. However, they need to continue improving their margins, they need to improve their profitability, and that is what will make them look like solid bets. First, I hope you enjoyed this video and learned something about what's happening in the IT sector across large caps, mid caps, and small caps. The key forces that are driving revenue, costs, and profitability, and some of the key trends going forward. If you love to get such updates, please don't forget to subscribe to our channel. Thank you so much for watching.